My name is Jake, welcome to the channel. In today's video, we're gonna talk about investing into REITs versus investing into physical rental properties. So what you're seeing here on your screen, this is my real estate portfolio here in M1 Finance. I have my cash flow portfolio here as well. With M1 Finance, you can have multiple accounts with the same login, and these are all taxable accounts. We even have a little account for our little baby Lucas, who is turning 12 months. Holy cow. The little guy is going to be 1 year old here next month. Time is flying like crazy. But yeah, so we have our cash flow portfolio. In this portfolio, it is only, qualified dividends. So we own companies and ETFs like Coca-Cola, Pepsi, etc. And in this portfolio, this is a non-qualified portfolio. So the taxes in here are a little bit less favorable than those in our cash flow portfolio. And what you'll notice, if you've been following the channel, this portfolio value here in cash flow is actually significantly higher than last week. My wife and I, we just sold our second rental property here in the last 4 months. So we sold our first rental in November of last year. We sold our second rental property here just last week. Holy cow. Pretty much last week, I've been transferring money from the sale of that property into the cash flow portfolio. So next week, I will talk more in detail about that, what that looks like. But for today's video, I really just want to focus on real estate investment trusts versus real estate investing in rental properties. And the topic is really top of mind for me right now because we just sold our second rental. And so in my real estate portfolio here, I keep it pretty straightforward, pretty simple. I have 12 investments in this pie here in M1 Finance. I have it broken up in both value and growth oriented REITs. So real estate investment trusts. And I'm not going to break down in this video and explain what a real estate investment trust is, but if you're interested, go over to my YouTube channel. I made an entire section around real estate investment trusts. And in each of these videos, I explain a little bit about real estate investment trusts. And if you've not watched any, you don't know anything about REITs, I would probably start with this video right here, the buy and hold forever. And then the other videos I talk about like different topics around investing into REITs. Like what is a REIT? How are REITs taxed? All of that fun stuff. But essentially, so here in my portfolio, so when you're investing, you have to understand your time horizon, right? Investing into a company like Omega Healthcare or WPC is going to be very different than investing into a company like Prologis and Digital Realty Trust. It would be the exact same thing as comparing investing into Coca-Cola, the business Coca-Cola, or investing into Apple or Microsoft. You have the exact same thing with real estate. You have more growth-oriented real estate and you have more value-oriented real estate, right? And so when we're looking at REITs, and so in my portfolio, I have a mixture of both. Omega Healthcare, MPW, WPC, Realty Income, Stag, etc. They're not growing as fast as maybe an American Tower or Prologis. But if you want to check out this REIT portfolio, I will leave a link in the description below. You can take a look at the individual companies that I own. And I also have a small percentage of my portfolio allocated to VNQ. This is the real estate REIT ETF from Vanguard. And so I really enjoy investing into REITs because I can get direct exposure into real estate. So that's the side when it comes to the real estate investment trust. About 3 or 4 years ago, I started going on YouTube and I started researching about real estate investing. So for example, I went and I watched, videos from Graham Stephan. I really enjoyed Graham Stephan's older videos, right? You see 3 years ago. And so yeah, the older videos of Graham Stephan were very helpful. I also really like Meet Kevin's older videos, like from 3 years ago, right? Like really older videos. His new videos, I'm not the biggest fan of personally. I mean, everybody their own, but I like his older videos where he talks about, where he would go and he would do like a vlog and he would walk through buildings and give updates. I've never bought any of his courses, nor will I ever buy them in the future. But a lot of his free content on YouTube from 3 years ago was really valuable to me. And also I looked at, I watched videos here from Bigger Pockets, Robert Kiyosaki, Ben Mala. I think when it comes to all of these channels that I've just talked about, Ben Mala is one of the only ones that I continue to watch because I absolutely love learning from somebody that actually does it themselves. And, his content is a little bit different than the others, but I really like watching Ben Mala. It's also very entertaining. I watched a few videos from PPC Ian, 4 years ago on REITs versus, rental properties. And this video right here from, Our Rich Journey from Aman and Christina, this was really what was the tipping point for me and my wife when we were looking to invest into real estate. When I saw how Aman and Christina, just your average people, could generate those kind of returns, it really got me thinking, okay, I can sit here and I can watch all these videos, but unless I actually do something, nothing is going to change. And so this video really helped us, or at least it helped me, when it comes to understanding, how you can leverage real estate to turbocharge your FIRE journey if you're looking to reach financial independence and retire early, or if you're just looking to build a real estate empire and have passive income, right? So these were some videos, and these were some of the things that I was doing just as a normal person without any experience. What I first started doing was I started educating myself by understanding what were some of the options when it came to investing into real estate. And fast forward a couple of years, we've experienced a lot of good things, a lot of bad things when it comes to investing into real estate, but there are a lot of things that I didn't expect would happen when I first started investing into physical real estate, and it kind of looked a little like this.
That was too close.
Oh my gosh. Oh, good times, good times. All right, cool. So I want to start off here and I want to talk about some of the pros and cons when it comes to investing into REITs, real estate investment trusts. So the first thing that comes to mind, and bear in mind, everybody, like these are just, things that I put together, thinking and pondering and, preparing for this video. What are some things that I personally experienced and some of the things that, occurred or happened to me as a do-it-yourself landlord, right? So this is by no means completely exhaustive. There's so many other things that you can learn when it comes to this. But when I think about from my personal experience, these are the things that come to mind. Okay, so to begin, the first thing, some of the first pros when it comes to real estate investment trust is liquidity. Liquidity is so important because when you invest into a physical rental property, a physical building, there is a longer process when it comes to, acquiring, purchasing the home and selling the home. When it comes to a real estate investment trust, they trade on the open market. You can go in your M1 Finance account, you can go in your Fidelity, your Robinhood account, you can click buy and sell, and within seconds, you have either purchased a stake in that business or if you have sold your stake in that business. So the liquidity piece is so important, and it is such a massive advantage when it comes to real estate investment trusts. The second pro with REITs is you get instant diversification. So if you invest into a company like Realty Income, you're going to get access to hundreds, thousands of buildings all across the United States. And in some cases, in some REITs, globally. Right? So you look at, for example, MPW, a hospital REIT, they don't only have facilities here in North America, but they also have some in Europe. So you get instant diversification when you invest into a REIT, and you can get even more diversification with some REITs than others. So that's something that I really like about real estate investment trusts is you get that instant diversification when you invest in some of these REITs. The third pro with real estate investment trusts is you generally are going to get a higher dividend yield. So the yield is what you're getting paid as a shareholder of the business, and REITs generally pay a higher starting dividend yield. And a lot of this has to do with the tax structure of a REIT, what makes up a REIT. And so when you invest into a REIT, you're generally getting a higher starting dividend yield. So for example, if you invest into maybe a company like Visa or Apple, you're getting a much lower starting yield, and that's completely normal. But with a REIT, it's very common that you can get a 4, 5, 6, 7% dividend yield, and that dividend is very safe. And so that is something that I really like about REITs is you can get a higher starting yield with a lower risk profile as for the investment. So that's something that I really like about real estate investment trusts. So the first con of a real estate investment trust is the lack of control, right? You are not the owner. Unless you're the majority stakeholder or shareholder of that business, which I would say 99.9% of people watching my channel are not. So you don't have control over the decision making of what happens with that, with the business. You do, if the company invests into a warehouse in California versus Texas versus New York, you don't have necessarily a say in what the business is doing. Now that can be a pro or a con, right? Like if you're like me and you don't know everything about different markets, that could actually be considered a pro because you want to let those do it that have the knowledge and the experience. But in many cases, the lack of control can be a con when it comes to investing into REITs because you're not the one owning and physically managing the property. The second con with REITs is there's often dividend cuts that come with real estate investment trusts. Just like any company out there, there's very well-run businesses and there's not so well-run businesses. And with real estate investment trusts, they're very sensitive to interest rates. And, whenever there's leverage, when there's leverage, there's always risk. And REITs are generally heavily leveraged because they're, it's just part of how their business works. So you have to be very careful of certain REITs because, some companies tend to cut their dividend more so when it comes to REITs. So you want to make sure that when you invest into a business that they're cash flow positive, that the fundamentals look good. So the fundamentals on a REIT are so important. And if you're investing into a business where the fundamentals are not sound, there's very likely going to be a dividend cut. And that for that reason, it is a con here on my list. The third con of real estate investment trusts is they are not tax efficient. They are actually tax inefficient. There is no special treatment for you, the shareholder, when it comes to taxes. For the company itself, it's very tax efficient. But for you as the shareholder, you pay a higher tax rate when it comes to investing into REITs. So if you are going to hold REITs, generally it makes the most sense to hold a real estate investment trust in a tax sheltered account. In most cases, that would be the smarter choice because you're not being taxed at the higher rate, your ordinary income rate when it comes to the dividend of a real estate investment trust. So the tax inefficiency is definitely a con when looking at REITs. Now let's take a look at some of the pros of rental properties. The first pro that comes to mind for me in my personal experience is leveraged returns. Okay, so what do I mean by that? When I talk about leverage, I mean I am taking money, I'm borrowing money, someone else's money, the bank's money, and I am investing the bank's money and getting the return based off of the bank's money. So for example, if I have $10,000, I can't really buy an investment property. It's too difficult. I don't have enough money. But if I go to the bank and say, hey bank, can I have some capital, right? I'm going to put down 25%, and will you loan me the remaining amount? And the bank will say, well, yeah, Jake, you're creditworthy. You have a good credit score. You have good debt to income. All right, we're going to loan you this money. And then I take the bank's money and I'm able to generate a return above and beyond just my money, but also on the bank's money. So the bank is, I get all of the upside when I leverage the bank's money. Now, in a down market, I also take on all the risk. So there's something to be very careful. You want to be very careful that you're not over leveraging yourself. You want to make sure that you're able to pay the bank back, or else bad things are going to happen. But overall, in my opinion, when looking at rental properties, I'm able to leverage the bank's money to amplify my total return. And over time, this can be massive. The second pro when it comes to physical rental properties is the tax benefits. There are so many tax benefits that come with investing into a rental property. Now you have to understand the government views a rental property as a business, and you as the owner of the business get all of the tax benefits that come with investing into a rental property. Whenever you have expenses with your rental property, they're all tax deductible. Like let's say you change the HVAC system, you change the roof, that's $25,000. You get to write off all of those costs against the income of your business. Owning a house as your primary residency, You don't get as many tax benefits as you would as a landlord owning a rental property. So the tax benefits, definitely a huge pro when it comes to investing into physical rental properties. The third pro with rental properties is access to capital. So you have actual equity in the home, assuming that you are not underwater and you have equity built into the home, you can tap into that equity. So say, for example, you have equity in the home and you want to take out a line of credit. You can borrow against the equity in your rental property. And so that can be very, very powerful if you want to get access to capital. And so that's definitely a massive pro when it comes to investing into rental properties. And so for your average person, when you hear access to capital, most people are going to be like, well, I don't even know what that means, so I guess it's not that big of a deal. It's a huge deal. If you're serious about investing into rental properties, access to capital, the tax benefits, the leveraged returns, for a serious person investing into rental properties, these are absolutely huge benefits that come with investing into physical rental properties. All right, now to some of the cons of investing into rental properties. Now, this is going to go beyond just cleaning toilets and getting calls in the middle of the night from your renters, okay? Those are kind of the obvious. The first con when it comes to investing into rental properties is the barrier to entry. The barrier to entry is very difficult. You have to have a lot of money generally in order to buy a property, unless you want to go and borrow the bank's money. But the bank is going to be very specific and be very critical of you. Okay, are you a credit-worthy individual or business? Is the bank going to loan you money? So the barrier to entry is definitely a con when it comes to investing in rental properties. It's not like investing on Robinhood and buying a REIT with fractional shares for $10, right? The barrier to entry is much higher. Now, the second con with rental properties is you have concentrated risk. If you own one building, in one city, in one state, there is a lot of risk that is concentrated in one area. And so, for example, if you don't have a duplex, you just have one single family home, if the renter were to leave you or, not pay rent, you are still on the hook to pay the mortgage to the bank. You still have to pay insurance. You still have to pay property tax. So you could also have a disaster. If you're cheap and you get really crappy insurance and there's a disaster, you have a flood or a leak or something, there's so many things that could go wrong. And so you have all of that risk in one place if you only own one single family home. Now there's things that you can do to mitigate that risk or lower the risk. You could invest into duplexes, you could invest into other things, but overall, when you're investing into a rental property compared to like a REIT, you do have concentrated risk. Now, the third rental property con that I want to talk about is none other than Murphy's Law. Anything that can go wrong will go wrong. I don't know what it is, but for whatever reason, if something can go wrong, it will go wrong. And I'll give you a few examples. It could be anything from renting to the wrong people. It could be renting at the wrong time. You could, for example, you could sign a lease with a tenant. A month later, the rents could go up and you missed out on that, right? Okay, that's something that went wrong. You could list your property for rent at a bad time of the year, right? You could have really bad tenants. You could buy a home that has damages that you didn't know about or have maintenance that you didn't know about, right? A faucet goes out, a toilet stops working. You have a once in a century freeze in Austin, Texas, and all of your sprinklers bust. True story. Our HVAC froze over here this last year in February when the freeze came. Our sprinklers got broken on our rental property. Our HVAC got broken. So thankfully we had money aside so that we could, we anticipated expenses. But what I'm getting at is when you're investing into rental properties, you have to assume that bad things are going to happen. You're going to have tenants that take advantage of you. You're going to have tenants that, have pets in the home without telling you. You're going to have tenants that, there's so many things that can go wrong. You could have bad neighbors. You could have the neighbor fight with the tenant. There's so many things that you can't think of everything, but I will say when you're investing in rental properties, you really kind of have to understand that if something can go wrong, it will go wrong. Okay, and that is definitely a con when it comes to investing into physical rental properties. So I guess my last final thoughts when it comes to this topic, whether you should invest into REITs or rental properties, I don't think there's a one-size-fits-all answer. I don't think everyone is going to be in the same situation. Every market is different. Everybody's background is different. Understanding is different. Everyone's risk tolerance is different. But I think this small list of pros and cons is a great way to start helping you think about, is this the right thing for you? But what I will say is if you're passionate about the FIRE movement, you really want to reach financial independence and retire early, I would highly, highly, highly encourage you to consider investing into physical real estate. Highly encourage it. Generally, people that are following the FIRE movement are more, they're driven. They want to, they're savers. They really want to turbocharge their investing. Real estate is a great way to do that. If you're in no rush to reach FIRE, and you don't really want to hassle with all the cons that come with investing into physical real estate, I think investing into REITs is a great way to get exposure to real estate. But I will say your returns, your opportunity to grow your net worth is very limited with REITs. If you really want to turbocharge and really grow your net worth over the long term, and in some cases in the short term, when you have a global pandemic, who knows when the next one will be or whenever we get out of this one. All I'm saying is timing does play a big role when it comes to investing into real estate, but it's something that I would definitely highly consider. One last comment is, if you know that you're not the right person for investing into real estate, don't feel bad. Don't feel guilty that, oh, I know that real estate's a great way to invest, but I just don't think it's right for me. That is completely fine. I think it's important. The most important thing is you know yourself, you know your limitations. And if you know that you're going to be unhappy and hate investing into real estate, don't do it. There's other ways to invest. There's other things that you can do. Okay. I think, there can be a lot of guilt, right? You know that you should kind of be doing something, or, everybody's talking about it, but you don't want to do it. You have to know yourself. And investing into rental properties is not for everyone. Thank you so much for watching, everybody. I hope that this video was helpful. If you have any questions in terms of the Austin market or my wife and I's experience with investing into real estate, leave me a comment and I will personally respond, and I'll try to answer all of your questions, or you can shoot me an email. The best way to ask me a simple, fast question would be to leave a comment on the video. I do try to respond to emails the best that I can, but if you have just a quick question, I will make sure that I respond to everyone's questions in the comments below. But yeah, thank you so much for watching, everybody. Hope everyone has a great rest of your Sunday, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.